Hello. Are fixed income an alternative to owning government securities? Does investing in fixed income funds provide you with an exposure to long-term government bonds and also corporate bonds without necessarily owning them? Hello, my name is Tim with Pete and Pete Investors, and at Pete and Pete Investors, we educate our members and provide them with tools that will hopefully assist them in making informed decisions in their journey to financial freedom. We are focusing on the capital markets and specifically the collective investment vehicles. Previously, I mentioned capital market is a marketplace where governments and companies raise capital either in form of debts or stocks. Government raise capital through debt by issuing an IOU in form of treasury bills for short term and bonds for long term. In exchange, investors lend government the money for a duration of time, and in return they are paid an interest, also known as a coupon, for that duration that they have lent the government the money, and at the end of the period they are paid back the principal. As I previously mentioned, collective investment scheme is just one of the vehicles of providing this exchange. Another vehicle is the Nairobi Stock Exchange. These are regulated by the Capital Market Authority, CMA, which is a government regulator who governs the rules and policy for their operation and provide oversight so that investors' fund is utilized prudently. But remember, it is not a guarantee because, as you know, investing, whether in bonds or stocks, is an element of risk. Bonds are considered the least risky, while stocks have a higher risk. It is important as an investor to understand this and evaluate your own risk tolerance and seek professional financial advice. I am not a professional advisor, but I'm simply sharing my knowledge and thoughts based on my research and hopefully can guide you in the financial journey. Back to the collective investment scheme. There is one fund that will be of our focus today, and that is the fixed income fund, which experienced 149% growth last year, increasing its percentage to 22% from 17% in Q4 of 2024, while that of the money market dropped from 63% to 56% in the same period. And this is what we are calling the Great Rotation. I have chosen a fund, Zimele Fixed Income Fund, not as an endorsement for the fund, but purely for learning purposes, so we can understand how the funds are allocated to the underlying assets. Based on the data from the fact sheet, 49.95% are allocated to treasury bonds, 29.92% are allocated to infrastructure bond, and 0.08% to treasury bills. This brings a total of 79.32 being allocated to Government of Kenya securities. I love data and I'm a data guy because I believe data provide a story. So now, as we examine what really happened between the money markets and the fixed income funds to understand what the story is, our secondary objective will be: can fixed income funds provide us with an exposure to government securities, that is bonds and treasuries, and also corporate bonds? So if this is something that interests you, welcome. Let's start with where the market stands today. Kenya Collective Investment Scheme industry closed 2025 at shillings 756.2 billion, up by 1,200% since 2018. Now, if you remember from our previous video, as I explained what Kenya's Collective Investment Scheme is, it's a vehicle where investors pull their money together, and it's under the Kenya Markets Authority or the Capital Markets Authority. Those are the authority that oversees this scheme. And inside this scheme, there are different funds. You have the money market funds, you have the fixed income funds, you have the special funds, you have the equity funds, and you have the forex funds. So investors pull their money together, and then fund managers create these funds. And then as an investor, you can choose where you want your money invested in, and the fund manager will invest on your behalf. So we have seen a tremendous growth since 2018 to where we stand at the end of 2025, where it was 756 billion Kenya shillings. The investor base has also doubled to 3.2 million accounts. And on this base, this market will cross the 1 trillion sometimes in Q2 or Q3 in 2026. Now, you have to understand this growth in the investor is mainly driven by retail investor, and a lot of them being domestic investors. And we'll speak later about what has caused this growth in our customer base. Now, zooming out, the growth has been remarkably consistent. In 2025 alone, asset under management added the largest in the history of the CIS, of the collective investor scheme, to 107 billion Kenya shillings in just 3 months. Growth, of course, has then since moderated from 27% to 11% quarter to quarter, but that's a market maturing, not slowing down. And like I mentioned, the investor base nearly doubled in one single year. So this tells you it's generally driven by retail adoption, mainly through fintech, and not by a large institution pouring in money or foreign investors. Now let's go to the next chart, and this is where it matters most. On the left, both the money market fund and the fixed income funds have grown in absolute terms. Both lines are going up. But on the right, you see that the share shifts. Money markets have gone from 63% of the whole CIS market to 56%, while the fixed income has nearly doubled its share from 17% to 22% in just 12 months. And this is what we're calling the great rotation. Capital structurally repositioned itself towards yield. Now, before we go any further, I want to address the obvious question. Is this rotation a warning sign? Are people fleeing from the money markets? The answer is no, absolutely no. Money market funds' actual base asset grew by 71% over the same period. It never contracted in a single quarter. Fixed income simply grew faster at 149%. This is new money choosing where to go, not old money running or exiting. And what is causing more money to go into the fixed income funds and not the money markets funds? There are several forces driving this. First is the falling rate cycle. As CBK cuts rates through 2025, the bond fixed income funds already held became more valuable. Yani, those funds, the bonds that were already held by the fixed income funds, became more valuable because the coupon rates were higher. And any new bonds that were being issued were attracting less coupon rate because of the falling CBK rate. Second, investor sophistication. Millions of people who started in the money markets as a savings substitute are gradually moving to higher yielding products, and also because of the digital platform, it's making this much easier. And third, fund managers economics. Money market is commoditized, so managers are incentivized to cross-sell to fixed income. And fourth, macro confidence. The shilling stability, because of we did a euro bond buyback, and this has given investors more confidence in our economy, and also the shilling has held steady throughout the 2025. So this has also given investors a little bit more confidence in our market, and so they are willing to take a little bit more risk. Let's look ahead. We model 3 scenarios for 2026. In our bull case, the market crosses the 1 trillion as early as Q2 in 2026. The base case, it crosses in Q3, and in the bear case, driven by a rate shock or currency stress, that milestone could slip past 2026 entirely. The key sensitivity is whether quarter-on-quarter growth holds above 10%, and that's the number to watch. I cannot mention best case scenario without also talking about what are the key risks. So no investment case is complete without the risk, and I want to be direct about this. The biggest one isn't a single risk in isolation. It is a defensive rate hike that would hit multiple parts of this thesis at once. One of them could be money pulling back into the money markets, creating a market-to-market loss on fixed income. That is, inflation has been tipping higher and higher, and because of that, the government could start reversing the drop in the base rate. Right now, it has held steady at 8.75. In case inflation continues tipping up, there's a likelihood that any new bonds that the government will issue will attract higher rates, and especially the short term. And so we might see money migrate back to the money markets, because then they will be attracting an equally good return. Should the rate continue dropping, then we expect money to be drawn more to the fixed income assets, which already had a higher coupon return. So that's one thing that could affect. The second one is the depreciation of the Kenyan shillings. And also, remember, we also headed towards an election year 2026. All these are factors that could affect our market and slow down the tremendous growth that we saw in 2025. Now, let's wrap up all this and make a conclusion. And in one sentence, the Kenya capital markets are in a multi-year structural rotation towards fixed income funds, and this is a healthy addition and not a flight from safety. Equally, the data has shown that fixed income funds invest heavily in government securities, that is both fixed bonds and infrastructure bonds, which are considered fairly safe. And this is something you should consider as an addition to your portfolio. In this slide, I'm also providing a list of top performing fixed income funds as of June 2026, which you can consider as a first step as you do your research as to whether you will include fixed income in your portfolio or not. I believe fixed income provide an exposure to government bonds and securities, and it's something you should seriously consider if you do not have any or if you want to diversify. Until next time, this concludes our talk today. So bye-bye.